Gold isn't a good investment. It doesn't yield anything. And if you're buying jewelry, it's just meant to make you look good. Meanwhile, gold in 2025 has beaten all other asset classes hollow. In dollar terms, gold prices are up nearly 38% last I checked. And if you thought that was crazy, just take a look at silver prices. After lagging behind gold for some time, it has now notched a 40+% return so far in 2025. Why is this happening? What's leading to the rise of gold prices and silver at that? Is it a good idea to invest at these levels? These are important questions to ask ahead of the festive season, but at any other point of time in the year as well. Because if gold and silver are too costly, how should you diversify your portfolio? I'm joined on MoneyWise today by Kirtan Shah, the founder and chief executive officer of Truvanta Wealth. Thanks so much, Kirtan, for taking the time.
Alex, thank you so much for having me.
So I was reading a few data points, very interestingly, right? Where you're talking about the central banks of India, Russia, and China having bought so much gold over the course of the last several years in the process of de-dollarization. You talk about foreign banks that are buying gold consistently. In fact, foreign banks owning more gold than they own treasuries for the first time since 1996. And all of this points to the fact that gold is a hot commodity. It's unlikely to go away. Is that what's causing the rise?
I think, Alex, if the genesis of this, in my opinion, at least in this part of the economic started, in my opinion, when the Russia and the Ukraine war set off. So what happened is US, for all known reasons, did not actually want Russia to continue with the war. And Russia, for whatever reason, did not agree to what US wanted. And which is why US did something that has actually led to what you see happen today. US actually sanctioned some $430 billion worth of Russian investment in the US treasuries, right? That actually got most other central banks to start thinking that tomorrow, if you don't ally with what US has to say, they will kind of freeze the asset in which you've invested, which is the US dollar, right? And which is why I think most central banks globally, since that point on, started deciding that they will want to reduce US treasuries and add more gold to the treasury portfolio, right? You actually also saw our finance minister say this a couple of days back, saying that it's a very prudent judgment that the RBI is taking to reduce US treasuries and add more gold to the portfolio. In fact, if you look, last year, first half, some 483 tons of gold was accumulated by central banks globally, which was a record. In fact, till the time of recording, the first half of this particular year, 2025, we have 420 odd tons of gold already bought by central banks in this first half of 2025 at $3,000 plus levels, which is huge, crazy, right? Another data, if I can share, in the first quarter, right, you've seen, like you rightly pointed out, in the last 3 decades, the first time that US treasuries are down 2% as forex reserves by central banks globally, and gold is now the second largest held treasury at 24% of the total treasury. There is definitely a clear sign post the Russia-Ukraine war and sanction by the US on Russian assets that de-dollarization is pretty serious, and central banks are looking at seriously accumulating gold, which is, in my opinion, a big reason why we've seen what is happening to gold.
So just hypothetically speaking, and I was looking at the quantum of gold, and there are some interesting statistics out there. If you were to try and visualize it, Kirtan, and I always find this fascinating, right? If you imagine a cube of gold, of all the gold in the world, it would be a cube that has, it's basically 70 feet in either direction, right? So you could actually fit it, relatively speaking, in any place, in a large stadium in Mumbai.
Yeah.
And there's only about 3,500, 4,000 tons of gold that is newly mined every year. So we're not really adding to the amount that much. And you've just pointed out, just central banks are buying 400, 500 tons in half a year.
Correct.
Just demand supply should tell you that prices are going to keep going up.
I don't see a reason why central bank in the near future at any point in time will slow down, because de-dollarization, in my opinion, is becoming a very, very, very serious data point. Because the strength of the US is actually that the world trades in the US dollar, and dollar is a reserve currency.
Yeah.
The only way you really can challenge US as a superpower, at least the way I look at it, is making the dollar weak, right? And I think everybody globally, and specifically the large BRIC nations like the Russia, China, and India, are probably trying their level best to kind of make this a more level playing field. Because you would have lately also seen and heard of how our prime minister also has written to BRIC nations that I want to trade with you all in the rupee, and we will transact and settle trade in rupee. China's been doing it, and I think everybody is trying to kind of reduce the dependency on the US dollar and try and make their country slightly less reliant on dollar, because that's the only way you are going to be able to challenge the US, if I may even use that term.
Yeah.
And understanding that I'm not saying it loosely, but the point is that dollar is the reason US drives its strength. And with what Trump has been doing, I think everybody globally is looking at this as a great opportunity to kind of leverage and de-dollarize.
Yeah. So, and that throws up a lot of conversation points as well. And I'll circle back to the whole concept of gold and silver in your portfolio. But before that, since you spoke about dollar and since you spoke about currency, I'm just wondering whether this phenomenon that we've seen has any bearing on the direction of the depreciation of the Indian rupee, because that's something that we've almost taken for granted over the course of the last 30 years or so. Since the start of the century, you're talking about 3+% of depreciation against the dollar every year. If the dollar is to weaken going forward, then does that change the picture at all for the Indian rupee?
It does, definitely, but it's not going to be as straightforward or as easy as we make it sound here, right? Because like we said, still 42% of the central bank reserves is dollar.
Yeah.
More than 60% of the world still trades in dollar.
Yeah.
I think the only way this really can start working for rupee is reducing our reliance on importing energy, because that's where we largely end up spending our dollars.
Yeah.
Because at the end of the day, this is the current account deficit problem, right? Unless your reliance on being able to hold dollars and import less does not reduce, you are always going to have faced this problem. So the only way we can really support the rupee is to make sure that we are able to export more than we import, which is where we are going to be dollar surplus. Again, reduce our reliance on energy, because that's the largest imported commodity where we give out dollars. And also try and increase as much as we can, invite foreigners to invest, right? That can be the capital markets through the FII route, or
which is not happening right now.
and investments in the company which are slightly more long term.
Yeah.
But the core of the problem is always to make sure that your inflation is under check and you're growing at a steady pace.
Yeah.
If the real returns are positive, I think largely your currency will be stable. But it's not going away anytime soon.
And not going away, and energy imports as well as gold imports, right? Because China and India are the largest consumers of gold. And ultimately that brings us back to the conversation, which is with prices where they are, and assuming, okay, the trajectory is indicating that it could go higher. Nobody knows what will happen in the next few months, but directionally you think that gold prices will go higher. So how do you place that in your portfolio? If you don't have exposure to gold right now, what should your approach be?
I think I've always believed that you should definitely have 10-15% of your portfolio as an exposure to gold for sure. Because if I can throw some data points where you look at the last 25 years of how gold has really been, only in the year of 2013 or 2015, if I'm not wrong, that was the only time you saw gold actually have a 19.1% drawdown. Except this, gold has hardly had any drawdowns in the last 25 years that you and I are talking about. Which means that gold actually brings in the diversification that you want in the portfolio, because your equity may move up and down, but gold still steadily holds the fort for you, right? And it's the best short-term diversification that your portfolio in general also wants, because in the near term, it's negatively correlated. So you want an asset to invest in when your equity portfolio falls that stays stable or goes up to balance your portfolio, right? And it's been able to do that with much lower volatility. So you look at the last 25 years, gold has generated the same kind of returns that equity has done, close to 13%. Now the argument may be that, we are talking at a point where the last 2 year gold returns are superlative.
Yes.
You remove the last 2 years and the remaining 20 to 23 years gold is still at 11% CAGR with much lower volatility than equity, right? And the same argument can be held true for equities also, right? If you remove the best performing years in equity, you will probably end up doing the same math that you will do in gold. So I think gold is a brilliant proposition. You should have 10-15% because in the short term, it brings in the diversification advantage, and in the long term with low volatility, it generates the same return like an equity does. No reason why you shouldn't have.
And we've spoken in a previous episode about the hedge against the dollar and the depreciation of the rupee, because ultimately you're buying an international asset. So there's that as well. But between gold and silver, do you have a preference? Would you at all buy silver? And the reason I ask is because early on the year, because gold prices went up as much as they did, silver hadn't gone up. And 60% they say, I know that there's no accurate representation of this, but 60% of demand for silver is through industrial use because it goes into so many electronics, etc., etc. And so therefore it could be more volatile than gold. So do you say buy silver?
I think that's a very interesting proposition. I would probably like to highlight 2 points that probably the investor community needs to hear through this conversation of ours. See, silver, like you rightly said, 50-60% of the silver demand is actually industrial. Yeah. 2 themes that have really played out globally very well over the last couple of years is EV and AI, right? And both have led the silver demand to go up significantly, right? Through AI, data centers and various other things have led the silver demand to go up. Through EV, again, solar panels, batteries, and all sort of things have actually led the industrial consumption of CV go up significantly. Or silver go up significantly. It is as significant that over the last 4 consecutive years, the supply of silver has been much lower than demand of silver.
Yes.
Right? And because of which silver's really gone up. But like you also rightly said, what you have to understand when you invest in silver is that silver, the larger part of silver rally largely depends on how good the industry is doing, right? Yeah. So if the industry is doing very well, you will have consumption of silver go up, and hence the demand and the consumption, and hence the prices will go up, right? So if you're looking at trying to add a hedge to your portfolio, silver may not be a great hedge, right? Because let's say if
it'll move in tandem with equity.
Absolutely, right? So it doesn't bring in that advantage.
Interesting.
Also, another reason why I think silver's gone up is because technically, if you look at silver is always pegged to dollar as a ratio. Okay. Right? You look at the last 25 years and the average gold-silver ratio is anywhere between 65 to 85.
And it went to over 100.
Right. So what it means is 1 ounce of gold will be equal to either 65 ounces of silver or 85 ounces of silver. That's been the average for 25-30 years. Today that you and I talk, it's 107.
Right.
Right? Which invariably tells you that silver is cheap.
Yeah.
Right?
Relatively speaking.
Relatively, right? And which is another reason why people who are finding gold to be extremely expensive are kind of buying into silver from a trade perspective. But please understand, all of this is very cyclical. Silver is extremely cyclical. There have been situations where silver has had drawdowns as high as 40-45% in a year, right? So when you are looking at it from a diversification standpoint, I don't really think that it solves the problem that gold really solves in your portfolio, because it's more cyclical, it's more volatile, right? And it, in the short term, does not hedge you against equity, which is probably the larger part of your portfolio as an aggressive investor. So I am more inclined towards having more gold in the portfolio because of the balance and the short-term diversification, yet giving you equity kind of returns versus a silver.
So, okay. So therefore, if you have to take allocation to silver, is it more from a tactical point of view rather than a diversification angle?
Oh, 100%. I think if you are a professional and who understands investing, I think to a larger extent, silver definitely is a more tactical play than a strategic play. So gold is more strategic and silver is more tactical. But having said that, gold can also be a tactical play provided you know how to do it. Because in the last 25 years, there have been 3 periods where gold once took 9 years and 2 times took 7 years to break the last high, right? Which means it gives you a lot of opportunity to be able to buy it and then, kind of try and outperform. But having said this, it's only for people who can actually know how to time and play the tactical play, right? But for retail investors who are probably more long-term in the investing thought process, gold is more strategic and silver is more tactical.
So how do you buy gold? Because ultimately, I've had conversations with people who say, hey, you know what? Family's got a locker in the bank. It's lying there. I might as well buy physical gold. You get a certification from certain places if you buy a coin or whatever, bullion, and you can buy physical gold because you don't necessarily trust the e-gold or the digital gold, right? But having said that, your ETFs ultimately do have underlying of gold. They are mandated to buy that underlying gold. If you're talking about a bees or you're talking about anything else. So how do you buy gold?
I have typically been asked this question and trolled on the internet a lot of time when I say this. But I think gold in the Indian household, unfortunately, is not actually an investment, but an emergency planning.
I'm not talking about jewelry.
Right? Because at no point in time I've come across somebody who told me that, gold prices have gone up so much, I sold it and I will buy it back at lower. But if you really want to use gold as an investment, there is no reason why you should not look at gold mutual funds, either through an ETF or the other way around in the mutual fund, because ultimately you are going to save 3% on GST, which is not the case when you buy digital gold, right? And of course, you don't have to be bothered about making sure that the purity is in place and the safety of the gold and all sorts, right? Because you don't have to do that which you do in the physical. So I see absolutely no reason why a gold ETF or a gold mutual fund is a far superior way to accumulate or invest in gold versus probably a digital or a physical gold.
So in the ETFs, is volume an issue? Is price discovery an issue?
Not really, but of course you have to be very cognizant of the fact that it's not trading at a much price is much premium to what the realistic prices are, right? So you can always go on to the AMC's website to check what the actual price should be versus what the ETF is trading at. But not really in gold is that a serious problem.
Okay. So, and also then timing, of course, is difficult to do, as is the case in any asset class. And you can get lucky or you can be brilliant. And it's very difficult to be brilliant, let's face it. And not everyone is lucky. So therefore, what is a way to accumulate gold over a period of time? Do you have an SIP approach?
Oh, 100%. I mean, look, there are two ways of really looking at it, because we are saying that your 10%, 15% of your portfolio should be allocated to gold. All you want to make sure is that at every point in time, you at least have at least that much allocation of gold. So you should typically try and mirror the same approach that you do for equities. Only then this balance can be maintained over a period of time. So if you're accumulating equity using SIP, you should have an accumulation that you do using gold, right? Because that's how you will make sure that largely, given outside performance in either of these asset classes, you will largely be able to follow the same asset allocation that you really start with, right? And whenever you try and buy lump sum in equity, try and buy lump sum in gold, because at the end of the day, we are saying that pricing is not the strength or the power that you have as an investor, right? So whenever you are doing whatever in equity, probably try and replicate that in gold over a longer period of time. It will kind of balance out what you want to do.
Okay. So I want to talk very quickly about, and we've spent quite a bit talking about gold and silver, but particularly about gold, and we've covered a lot of ground. But I do want to talk about the other aspects of your portfolio, right? So equity being predominant, I have a question there. International equity, fixed income, and possibly on REITs as well.
Sure.
So to run through all of these, one, equity. I've met a few people over the course of the last 1.5 years have come to me and said, look, hey, you know what? I've been doing SIPs, but it's been yielding me nothing. And let's face it, 2025 has not been the best year for equity, right? Some people are calling it a year of consolidation. What is the advice that you would give to these people who say, look, I'm getting nothing for my investment?
I think I always keep saying this. If ever you've used the local transport in Mumbai, or you've gone through a train while you are trying to take the ticket, you will generally see that the other line moves much faster than the line you are in.
Or if you're waiting for a toll, right?
Right. So what you do is then you try and move to the other line. As soon as you move to the other line, you see that your line starts doing very well.
Let me just say, I have the worst luck on tolls. the worst luck.
Right? Everybody will relate to what we are trying to say. Right? This is exactly what happens, right?
Yeah.
Look, what you have to understand is equities are not fixed deposits. They don't pay you 10 or 12% consistently, repeatedly over a period of time, year after year, right? It averages out to give you 10, 12%, right? That average happens because some years it is down and some years it is up. The last 1 year, the day you and I are talking, the last 1 year return on Nifty is minus 1.5%.
Yeah.
And this is absolutely normal. In the last 44, 45 years, there have been only 4 years where the intra-year fall from the peak of the market has been less than 10%. What I mean by that is out of 44, 45 years, 40 years, there has been a case where from the peak, Nifty has fallen 10% intra-year.
In 1 year, within that year.
Within that year. Yeah. It is that normal, right? So it is just too much of expectation or probably unrealistic expectation for your equity to behave like your fixed deposit. You have to understand this. Now, theoretically, you might say I'm in it for a 5-year haul or a 10-year investment, right? But if in the first year you're going to get scared by your portfolio showing you minus 1.5%, you are never going to make that 10, 12%. So please understand this is actually a feature and not a bug.
Okay. So keep those investments going.
Absolutely.
As is, right? That's part of your diversification strategy. Second part is international equity. It's getting harder and harder for an Indian investor to take exposure there. Of course, you can say that the liberalized remittance route is available, scheme route, LRS route is available. But then that's one aspect. And the other aspect is India's underperformed relatively all of these international markets. And a lot of them, including the US, has run up like nobody's business, right? So therefore, how do you look at that strategy at this juncture?
See, look, one theoretical answer is you still have ETFs that you can use to invest in global markets, right? But the point is, should you or should you not?
Because there's a gap, right, in the price and the actual NAV.
Absolutely, right? The point that I really want to make is that if India is the fastest growing economy globally, right? Do you really have the need for you to look at global exposure?
Sure.
Because if you're going to invest in gold will actually give you the 3% depreciation that the global investment brings on board. So the diversification advantage that you really bring on board is investing in equity outside of the country.
Sure.
Right?
Yeah.
You look at the S&P 500 and you will know that probably it's only the Magnificent Seventh which has generated more than 50% of the returns that the entire S&P 500 has generated. It is that concentrated as a portfolio. Do you really want to bet in such high concentration? That's a call that you will really have to make. And look, we are talking at a time where markets have significantly done well over the last 1 year for the global players. You remove the last 1 year or the last 18 months and you will see that the average performance of global indices outside of the US is not that great at all, right? So I think it is just the near-term bias that is working towards global investing.
And FOMO to a certain extent.
So I am somebody who believes that you probably want to keep your domestic allocation in India to be highest, have some allocation to the US because because let's face it, they are the innovative leaders, right? China, while they are, but there is too much of a geopolitical problem in general to be wanting to invest in China. Everywhere else, I'm not sure if a retail investor really even understands what's happening in Brazil and Canada and Argentina.
Sure. So point well made. Last 2 points, and I'm going to club them because ultimately you're talking about fixed income when at a time when there might still be 50 basis points or half a percentage points of cuts by the Reserve Bank of India, and bond yields have been relatively elevated. They could fall, and so there's a benefit on capital gains. I don't know if that should determine whether or not to invest in fixed income. It shouldn't. But what is your strategy there? And should you also include REITs?
So currently, if I remember one of the shows that we did some time back, I was very positive on doing long duration because we were expecting interest rates to fall, and that actually played out really well for investors. At this point in time that you and I talk, we are more betting on the credit cycle in India versus the duration cycle in India. So if you are a sophisticated investor who understands the risk in fixed income, right? Credit may be a great opportunity versus duration at this point in time. And I think REIT definitely is a very interesting diversification that you should really look at. Of course, there are not a lot of examples that I can go back and talk about, but out of the three listed, if I look at two, one is 5-year-old and another is 3-year-old, they've easily given an 8% CAGR of yield, which is great, right? And also there is a capital appreciation opportunity. So the CAGR on Embassy, if I'm not wrong, since the last 5 years is close to 10.5, right? And on the other one is 9.4, 9.5. I think it's a great play because on the capital gains, you are taxed as equity. And on your yield, you are going to pay as much as your debt.
So therefore, what exposure is appropriate?
Again, another 10% can be great, but this is still evolving. There are not a lot of opportunities in this space. And I'm hoping and assuming that a lot more opportunities will come up. But definitely sophisticated investors can look at diversifying a little in REITs.
Yeah, I've had fantastic fun on this conversation, and we've covered a lot of ground. Kirtan, thanks so much for taking the time.
Alex, thank you so much for having me as always.
All right, well, that brings us to the end of this edition of MoneyWise. Tell us what you think and let us know what you'd like to hear on this program. Meanwhile, stay tuned. This is NDTV Profit.